This is a lecture from Open Tuition. For the free lecture notes that go with this podcast, please visit opentuition.com.
Page 38. I introduced to non-controlling interest early on this morning. Non-controlling interest is those providers of finance other than the parent company. The people who provide the finance for the subsidiary other than the parent. So in an exam situation, it will not be, and your structure will not be, I guarantee it, that will not be a structure. It will not be 100% ownership by the parent. So we're building up a little bit more complications. And what we finish up with is a parent and a subsidiary, 75%, 25%. 80-20, 60-40, 62-38. He's not going to do that to you. Steve Scott's a nice man. He's not going to give you 62.25% owned by the parent and 37.75% owned by the non-controlling interest. He won't do that. It will always be 60-40, 70-30, 75-25, 80-20, maybe 90-10. It's always going to be a nice number rather than 62.419. So working one changes. Working one showing the structure will change. Working two also needs to change. The goodwill calculation, which is a bit of a shame because I've only just introduced you to the goodwill working, but now I'm going to change it. It's going to build up on top of what I've already just given you. If it's a 75-25 structure, the top line is still going to be cost of investment. And all these figures now, I'm making them up. They're all say figures. Cost of investment, 40,000. Now 40,000 bought 75% of the net assets of the subsidiary. We bought control. It actually only gives us ownership of 75%. And what I'm looking at is what is the value of the subsidiary at date of acquisition? Well, I know 75% is valued at 40,000. What I now have to do, I wouldn't write this into the exam, but that's the 75% cost. What I now must do is find out the 25% cost to give me 100% value of the subsidiary. But I wouldn't write that into the exam. But that's what I'm doing. If 40,000 was the cost of 75%, what's 25% equal? The answer 13,333 would be good, but it's not likely to be right, because I'm not just buying 75% of the fair valued net assets, I'm also buying control. So I'm likely to be putting a premium on the value of 75% of the net assets. So the value of the NCI investment is going to be, say, 12,000. So now I know what the subsidiary was worth in my mind. Now where does this 12,000 come from? This particular 12,000 on the screen, you've just seen me make it up. I've just said, say it's 12,000. But the examiner will tell you. He's got a number of different ways in which he will tell you, but we will be able to calculate the value of the NCI investment. So I've now got 52,000, which is the worth of the subsidiary at the date I obtained control. I'm now going to compare that with the fair value of the net assets of the subsidiary at the date I obtained control. So fair value of the S net assets at date of acquisition. The fair value of the S net assets at date of acquisition. And we know that net assets equal shareholders' funds, and information will be in the question to tell us the share capital will not have changed. It may be 15 years after acquisition, but the share capital will still be the same at F7. It will still be the same share capital today as it was 15 years ago. So share capital, again, say 20,000. Retained earnings. Per the question, it will tell you what the retained earnings figure was at the date of acquisition. Retained earnings, say 30,000. The value, the fair value of these net assets at date of acquisition, 100% of the subsidiary's net assets, is therefore going to be compared with our valuation of 100% of the subsidiary, 52,000. That was how much we paid for 75. That's how much the examiner will tell you was 25's worth. I've got 100% value, that's 52,000, but the carrying value, or the fair value I should say, the fair value of the subsidiary net assets is only 50,000 because I've got this additional asset of goodwill. Now this happened 15 years ago. And annually since then, the directors have carried out an impairment review. And so I did have an asset 15 years ago of 2,000, but since then it has been impaired. So the asset needs to be written down. Impaired since acquisition. Let's say 700. This intangible, non-current asset, goodwill, is now only worth 1,300 to me. And that's the figure that will appear on the statement of financial position. If I've credited goodwill with 700, where's the debit? If I've reduced the asset by 700, where's the debit entry? Leonard. Again? No, well, yes, all right, expenses. It's going to come off retained earnings. It's going to come off retained earnings. Since acquisition, 700, and retained earnings we know is working 3. So the consolidated retained earnings figure now also must change. Holding company, subsidiary. As normal, per the question. I'll put some make-believe figures in. Say 40,000 for the parent, 32,000 for the subsidiary. Less pre-ac, which you should by now be getting used to the idea of taking the pre-acquisition profits off the subsidiary's results. Pre-acquisition, we decided up here, pre-acquisition was 30,000. So deduct the pre-acquisition from the subsidiary today. Therefore post-ac. And our share is 75%. According to working one, according to the structure, it's there, our share is 75%. 75% of 2,000 is 1,500. So H's own 40,000, and H's share, 75%, of S post-acquisition retained gives me 41,500. But goodwill only exists on consolidation. It doesn't feature in the parent company's own financial statements. It doesn't feature in the subsidiaries' financial statements. It only exists, it comes alive on the process of consolidation. So these retained earnings figures of 40 and 32 have not suffered any goodwill impairment. But we need to impair. We know we have impaired by 700. So I need to deduct from this figure of 41,500 less goodwill impaired since acquisition. Just our share. Just the parent company's share. %75% of 700, which is 525. And so the consolidated retained earnings figure on the statement of financial position, consolidated statement of financial position, will be 40,975. And working three, therefore, needs to change. And I know some of you were testing each other at coffee time. I know that you were doing this, and you're saying, what's the basis of working three? And I heard you saying, it's H's own and H's share of S post-ac retained. Well, it is, but we must now deduct our share of the goodwill impaired since acquisition. So it's a three-line mantra. H's own plus H's share of S post-ac retained less goodwill impaired since acquisition. Just our share. We also need a new working four. Working four is the NCI. And it's the calculation of the NCI on the statement of financial position. And for your own benefit and to try and eliminate silly mistakes, I always suggest that you should put their share in brackets at the top of the working. And the calculation of the NCI for the purposes of the statement of financial position is, again, it's a three-step process. It's their value as at date of acquisition, and I forgot what figure I made up, but we can find it in working two. I'll just go back up to working two, It's there. That was their value at date of acquisition, 12,000. Their value at date of acquisition, 12,000. But they also want their share of the S post-AC retained. They want their share of the subsidiary post-acquisition retained. And we can find that in working 3. It's here. There's the S, and there's post-AC, so it's their share of 2,000. %25 of 2,000. So they're entitled to 12,500. That's what they started with when we acquired the subsidiary. They started with a value of 12,000, and since acquisition, the subsidiaries made some profits. And the non-controlling interest want their share. But there's been an impairment in goodwill, and therefore they should be charged with their share of the goodwill impairment, so less their share of goodwill impairment. And that's 25% of 700. Just have a look at the workings. They're set out for you on page 38. Working 3 is set out slightly differently than I've done on the screen. I'm doing it now consistent with the way I've shown you on the screen. The way I showed you first thing this morning, I will always set it out the way I have done it on the screen. But then we've got an example on page 39. Aushra and Dinius. The only one thing you may not be happy about or not certain about is the word after the Dinius, the second time Dinius is mentioned on the top line. Dinius is mentioned twice on the top line. The word after the second Dinius. Now those of you who did law will know what incorporation is. Oh, let me pick someone at random. Anastasia. Irina. Lena. Svetlana. No, it's not the acquisition of the subsidiary. Vita? Vita. Ginter. It's the date the subsidiary was born. Yep, it's the date the subsidiary was born. It's the date of creation of the subsidiary. It's the date the subsidiary was created. So with Aushra acquires 60% of the share capital of Dinius at the date of incorporation. A year later, the two entities have got these statements of financial position, and goodwill is impaired by 25%. There is something a little bit technically wrong with the question, but I'm not going to tell you what it is. We also have the directors have valued the non-controlling interest. At the bottom of the figures there, the directors have valued the non-controlling interest as their proportionate share of the fair value of Dinius net assets. That word proportionate is important. It is most unlikely in the exam that the non-controlling interest will be valued on a proportionate basis. It is most unlikely. But I'll show you the effect of valuing the NCI on a proportionate basis. Can you do working one? Do working one. Okay. Working 2, I do not want you to copy this down. Do not copy this down. I'm going to separate us and the NCI. I'm just separating them just for the moment. I won't do it again. This is the only time I'm going to do it. And it's not therefore the way for you to do it in the exam. But it does explain something a little bit, hopefully, a little bit clearer. Cost of investment, 16,000. That's how much it cost us. The value, this figure here, we don't know. But we're told that the NCI value is proportionate to the value of the net assets at date of acquisition. We do know that. If I now look at the net assets at date of acquisition, that's shares, 20,000. Retained earnings. Don't write this down. Stop it. Do not. Oh dear, I did have a course here. I had a course here a number of years ago. And I had a student, a man, who insisted on writing everything down. Everything I put on the screen. If I put a circle on the screen, he had a circle in his notes. Everything. And there was something where I particularly didn't want anyone to write it down. I said, because I knew what he was like, I said, do not write this down. And I looked up and he's writing, do not write this down in his notes. Don't write it down, because it's not the right way to do it, but it does illustrate a point. Retained earnings. What were the retained earnings at date of acquisition? Ginter? How many? I missed what you said. Say it again. Say it again, Sam. Yekaterina. No, it's not 6,000. No, it's not 6,000. Renata? Vita? 0. 0. We bought our investment in this subsidiary on the day it was born. How long is it? When you have babies, how much profits have those babies made the moment they are born? None. They can't have made any profits in that moment of delivery. It's made 6,000 profit instantly. It can't happen. So we've got this baby here called Dinius, and it's just been born, and we bought our 60%. It can't have made any profits. So retained earnings is 0. So 20,000, therefore, are the net assets of the subsidiary at date of acquisition. And if I allocate on the basis of 60-40, then 60% of that 20,000 is mine, and 40% of it is 8,000, and that belongs to the NCI. Don't write this down. Still, don't write, do not write this down. And we're told that the value of the NCI is the same as their proportionate share of the fair value of Dinius net assets. Well, their proportionate share is 8,000, and the value, therefore, of their investment is the same, 8,000. The value of their investment is the same as their proportionate share of the net assets at date of acquisition. So there's no goodwill attributable to them. They don't have any goodwill. And if they don't have any goodwill, we can't charge them with their share of any impairment. All the goodwill in this acquisition belongs to the parent company. There is no goodwill attributable to the NCI. The goodwill is 4,000. So when that is impaired, and it's impaired by 25%, our share of that is 25% of 4,000, 1,000. So if it says that the NCI is on a proportionate basis, the value of their investment is the same as their share of the net assets, and therefore there is no goodwill. And therefore any impairment is entirely ours. Nothing will be charged against the NCI. All right, now we can start writing it down. So let me get rid of all this. I'm not going to have columns for us in the NCI. It's just going to be cost of investment, and we're told it's 16,000. The value of the NCI investment, we don't know until we know what the net assets were. I do know they have a value, but I don't know what it is until I work out the net assets at date of acquisition. The fair value of the subsidiary net assets at date of acquisition are shares, 20,000. In an exam question, there will be retained earnings. There may very well also be share premium. The share premium account could very well exist in the exam. We've not come to that problem yet. But retained earnings we've just established were 0 at date of acquisition. So the fair value of the subsidiary net assets at date of acquisition were 20,000. Now I have this figure. Now I have this figure, I can work out this one. I can work out the value of the NCI. It's proportionate. It's their proportion of this 20. 8,000. It's 40% of 20. Once I have this, then I can work out what is their proportionate share there. So the total value of the subsidiary is 24. The fair valued net assets are 20. Therefore goodwill is 4,000. And the question tells me it's been impaired. So less impaired since acquisition. Is 1,000, 25%. So on the consolidated statement of financial position, I have 3,000 goodwill. That's working 2. Working 3. Consolidated retained earnings. Now Stratton Dynus. For the question, 20 and 6. That's the pre-ACC. Well, there was no pre-ACC. We bought on the date of incorporation. Therefore, post-ACC was 6. And our share is 60%. Which is 3.6. The printed solution is incorrect. So on page 157 the answer is wrong, and 158 the answer is wrong. 157 and 158 the answer is wrong. But don't worry about it, because we're doing the right answer on the screen. So your own notes will be as close to perfect as is possible. I need to deduct from this consolidated retained earnings less goodwill impaired since acquisition. And I've just established that the entire 1,000 is our share. So consolidated retained earnings are 22.6. And working for is the NCI. It's on the statement of financial position, and their share is 40%. The value at date of acquisition was 8,000. It's there in working too. It's there in the goodwill calculation, 8,000. But they also want their share of S post-ACC retained. And that's actually in working 3. You just pop up to working 3. There's S, post-ACC, retained, 6,000. They want 40% of 6,000. $2,400. And normally we will find in the exam we'll have less their share of the goodwill impairment, but because they were valued on a proportionate basis, they don't have any goodwill, and therefore we can't take any goodwill from them. So 10,400 is the figure for the NCI on the balance sheet. So now we're in the position of doing consolidated statement of financial position. Top line, Renata. Top line, Ekaterina. Top line. What comes first? Günther? Intangible non-current assets. It's in working too, and it's 3,000. Other assets, 24 and 30. Total assets, 57. Shares. What are the next three words which I'm not going to say? What are the next three words which I'm not going to say ever, ever, ever again? I always promise never, ever, only to say these words a few times. What are those words I'm looking for, Günther? Yeah, those words, you got the right idea, but the three words, and I'm surprised that you weren't saying them to yourself down at the coffee machine. What are those three words, Vita? Always, only, ever, the parent company. Always, only, ever, the parent company share capital. Shares, 18,000. Consolidated retained earnings, that's in working 3, and I think we got that to, what was it, 22.6? The next line is the NCI. They are providers of capital, they're part of equity. The NCI are part of equity, it's not us, but they are shareholders. And the NCI is in working 4, and the figure we arrived at was 10.4. So shareholders' funds, 51,000. Current liabilities, 2 and 4. So the assets and liabilities are what the group controls. Equity section is who actually owns them, and that includes the NCI.